Hi, I'm Mark Wooster, the Chief Investment Officer for Calibre Investment. Today I'd like to talk about the global economy, a bit on the markets and how the portfolios are travelling through this COVID-19 crisis. It'll be pretty high level. We'll have other videos where we dig into the detail a bit more, so look out for those. So it's been a couple of months since we realised the virus wasn't going to be contained within China with a little bit of leakage. Before that there was a lot of complacencies, both from government and markets, that the virus would be contained and it would be a SARS type event where there was a bit of economic fallout but nothing enduring. But as the virus spread, the impact then became a lot more obvious, and that impacted both economies and investors in the markets. So the big issue that nobody foresaw was the economic impact of the lockdowns. So that's obviously been extreme, and we need to throw away the textbooks on this one because nobody's been here before. And we need to look past the numbers because this is a mandated government shutdown, and so it's not a fundamental problem with demand and supply, although now obviously the shutdowns are affecting demand and supply and will do for some time. So the markets have been trying to figure out what's been going on because, as we say, we haven't been here before, and about a month ago they were struggling quite a bit with huge levels of volatility. We saw the big international liquid markets up 10% one day and down 9% the next day, and they were struggling to find a bottom about a month ago. But since that point, markets have rallied from that low point on news that the virus may be starting to level out in the Northern Hemisphere and in Europe and in the US. But there has also been a lot of stress in bond markets as well. And central banks have come in and actually provided a lot of liquidity in those bond markets, and that's given those markets a lot of confidence that they can actually transact and set prices. And so the other thing that has really encouraged markets is that governments have come to the party big time. The governments around the world have made a huge commitment to limit the damage that these shutdowns are having on the economy. And so we're seeing government relief packages in the US of $2.2 trillion. That's 10% of GDP. In New Zealand, the relief package is about $20 billion. So a lot of people are talking about fiscal stimulus. At this point, these are really much more relief because it's a matter of trying to get the economies through this lockdown and this critical part of the crisis. It will flip to fiscal stimulus as weeks and months go by, as we come out of the lockdowns and we try and mitigate the impact of the lockdowns on the economy going forward as the businesses reopen and market starts to normalise. The big issue we've got to realise in terms of where we are is there's going to be a big difference between financial markets and the economy going forward, because the financial markets could very well be in recovery mode while economies are still struggling. The economies could have still, small business failures, some businesses struggling to get back to normal, while the financial markets are in recovery mode. So because financial markets are looking through a lot of those numbers and looking about 6 months ahead. So the other thing to remember, that this is not a financial crisis. A lot of people are referring to it as a financial crisis because they're thinking back to the global financial crisis, which was a true financial crisis. So that crisis was caused by problems and stresses in the financial markets, and that flowed through to the real economy. In this case, there hasn't been stresses in the financial markets that have flowed through to the economy. In this case, the economic impacts of the shutdown and from the impact of the shutdown from the virus are causing problems in financial markets. So how are the portfolios going through all of this? Well, Calibre's investment management operations are continuing pretty much as per usual. Our research, our portfolio construction, trading operations, monitoring monitoring and review are all just continuing as normal. We actually normally do a lot of travel and actually work from home quite a bit normally anyway, so we're actually quite well set up to work from home and individually, and we coordinate obviously via Skype and Zoom and Teams and so on. We are paying a bit more attention to things like liquidity, and we're also having a lot more video calls with managers just to monitor how they're travelling through this process. But we're not seeing any stresses in the underlying managers or the assets. So the portfolios are coping really well with this environment and the volatility. They're actually designed for periods like this. And so why do we say that they're designed for periods like this? It's because we know from the outset that it's not going to be plain sailing. We're going to have periods like this where it's going to be a bit lumpy. And so knowing that, we actually make sure that the portfolios are designed and positioned to actually cope with this. And so one of the key elements and features is diversification in the portfolios. So we actually in the growth portfolios, we actually have a lot more exposure than just straight equities. So we have currency, cash, fixed interest, alternative strategies, and so the whole is greater than the sum of the parts. It's a bit like a cake. You know, when you look at the elements on the counter, they don't look that much, but when they're brought together and mixed up as a cake, the outcome is quite different. And it's the same with the portfolios. And it's things like currency. You know, currency for us is actually quite a deliberate exposure because the New Zealand dollar, for example, was down around 17%. Well, that actually provides quite a good buffer for the portfolios because the portfolios have international holdings. And so it's a very deliberate strategy. It's not there by accident, just by dint of holding those assets. And it's an example of how these various elements contribute to the performance of the portfolio through periods like this. So the growth elements in the portfolio will go up and down a bit with the markets, but we focus much more on making sure that the underlying exposures are sound rather than trying to chase returns. And unfortunately, at the moment, some investors out there are finding out that the yield enhancement investment that they went into is a lot more volatile than they realised, and that's why we don't get into that. We don't chase yields, we don't chase returns, and we focus a lot more on the underlying exposures and making sure that they're sound. So they're designed and well positioned going forward to meet your objectives, and so the portfolios are designed to get you through your investment time frame. Thanks for watching. Stay safe.